Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is July 10th, and it is Monday morning, and this is The Talking Point. Thank you for joining me. We have a very busy week this week, filled with the earnings season, filled with very important data releases. But I want to just look back for a moment from last week in terms of the payroll report. The payroll report on Friday of 209,000 new jobs created was less than consensus estimates for what the market had expected the jobs report to suggest. That said, 209,000 new jobs is certainly suggestive of still resilient labor market, one. But also, when we look under the hood in terms of components within that report, I want to go over two especially. One is that we saw the hours worked tick up a tad. That was a concern because if you have hours worked continuing to decline, it obviously suggests that demand is slowing for labor. I do want to have an asterisk here and not get too complicated in terms of that particular component. That is to say, the hours worked each week. In this odd backdrop that we seem to be living in, right? Rates go up and yet the economy remains resilient. One thing that employers can do, they could cut the hours for workers, keep them, don't fire them, but keep them, but lower the number of hours that they have. That is also a possibility if we were to see lower hours, weaker hour demand for labor. But we didn't. The work week, the hours worked climbed higher. That was actually good news. It didn't skyrocket, but it suggested that perhaps the month before, where hours worked came down, was a one-off. Second, and this is important for the Federal Reserve, and all eyes are on the Fed, there's no doubt about that. And that deals with the wages. Wages climbed higher. They've been leveling off, but they inched a bit higher. This is not something that the Fed wants to see. Let me go over the reason yet again. When you have higher wages, it is like any other input cost. And because we are really a service sector economy, wages are very important. However, many companies are going to try to pass that higher wage into higher prices, and that, of course, fuels inflation. So you don't want to see that. You really want to see wages come down. Now, one thing that is positive, we see new workers coming into the workforce, and that allows companies to have, a larger pool of workers and not be forced to, offer a signing bonus to push wages much higher. So we'll pay attention to that. And it looks as if Americans I saw this headline and I loved it, quit quitting. So we're not seeing as many Americans quit jobs. We are quitting, and we're moving to jobs that are paying more. That usually is the way that it works. But it's slowing down. That quit rate is slowing a bit. Now, also, I do want to point out in this, we saw the 3.7% unemployment rate tick down to 3.6%. So again, the headline number of 209,000 new jobs, I'll tell you, it was focused on healthcare workers and also education. But also we saw construction hiring also continue to edge higher. And, of course, hospitality. But it was really focused on healthcare and private education. So all in all, still suggesting a resiliency in our economy. And remember, when we take a look at the ISM, Institute for Supply Management, this is the Purchasing Managers Report. I cannot stress this enough. In the service sector, remember that is the largest component of our economy. 50 is the line of demarcation. Below 50, you're in contraction. Above 50, you're expanding. So the number that came out last week is climbing higher above 50, about 53. It had been just about 51 before the report that came out last week. And it suggests that that service sector in our economy is actually doing well. The only thing I want to add here, though, is the prices paid component. It hasn't climbed higher, but it is not climbing lower. We would like to see it pull back even more than where it is right now. But overall, suggestive of still a strong economy. Orders were up, expectations for hiring were also inching a little bit higher. In terms of manufacturing, however, the ISM, Institute for Supply Management report, shows deeper contraction. And so this is obviously a concern, but overall, we still have an economy that is resilient. That's the word that we want to use, resilient. Now, looking ahead this week, we are going to be focusing on, yes, the economy, but we're going to be looking at it in terms of the Consumer Price Index. The CPI report comes out on Wednesday, and all eyes are on inflation. There is no doubt about it. There's a tug of war emerging at the Fed. This week we'll get more of it as they come out and speak, the doves versus the hawks. Today, Loretta Mester, the head of the Cleveland Federal Reserve Bank, she's due to be speaking, and she was in the camp for the last meeting. Hey, let's just raise rates, versus Raphael Bostic, head of the Atlanta Fed, who has come out very clearly in terms of, why don't we just pause and, kind of pause for a long time, and let's see how the cumulative effects of the rate hikes are affecting the broader economy. There is another third way, and I want to add this to this call, and that is, wait a minute, are we going to wait another year to see how this is going to unfold? Perhaps, just perhaps, the economy, because the labor market remains solid, because consumers continue to spend, albeit more carefully. We're actually buying more vehicles, by the way, big ticket item. Maybe we're just absorbing the higher rates, because again, the underpinning for the economy remains resilient. The question, of course, that everyone has is, are we going to hear from corporate America as we enter this earnings season that they are under pressure? Are they going to tell us that revenues are down, that their operating margins are under pressure, they have to pay more for wages, and therefore, do they have to cut expenses and lay off more people? This is going to be an important theme in this earnings season that is opening up officially this week with the big banks. We're going to be paying attention over the weeks as to what companies are saying. Here, too, amongst analysts, a tug of war. Some are saying, look, the bar is low. Companies are going to beat expectations, and we're going to just continue to maybe muddle through. It's not going to be that bad. Versus those who are saying, oh, not so fast. We're going to hear companies saying, we're under pressure and we're going to have to lay off. So this is going to be interesting because we have gone through one earnings season after another. Remember, we always look back. It's the second quarter, right? We're not in the second quarter anymore, and therefore guidance is going to be crucial. Absolutely crucial, especially with an S&P 500 trading at over 18 times the next 12 months. And it's, based on the big mega tech names. Now, this is where the earnings become important. Are we going to hear from those big mega tech names that have been really pushing this market higher? Are they going to come in, as they have in past quarters, with strong revenues, right? Bottom line earnings coming in above expectations, positive guidance, and are they going to lead us out of the earnings calls? So that's not for this week. This week it is the big banks. What are we looking for from the big banks? We want to hear, and by the way, by the time they finish this week, we'll have a very broad picture of the underlying economy. We want to hear about loan growth. We want to hear about our companies, individuals paying their loans. How quickly are they doing it? Are their delinquencies picking up? And also, we want to hear what their expectations are for growth, and particularly on the investment banking side, because there are some green shoots within investment banking suggesting that initial public offerings are, going to be filed. We had a couple this summer. There may be some more that are are indicating that they want to go public. These are all important because what they underpin is strength in the markets, right? That's why we pay attention to it, because that's what they focus on, strength in the markets. In addition to all of this, we will get a picture of individuals, again, our credit usage, and we will have a picture on corporate America, because they lend to corporate America, the big banks do, and we want to hear whether or not loan growth is picking up. And so, again, an important week, because we will hear from a number of money center banks and regional banks that actually have different strengths, they have different areas that they focus on. So this is going to be a busy week. Also, tomorrow on Tuesday, we're going to hear from the National Federation of Independent Businesses. This is their optimism report. Why is this so important? Because it is the small business owner. By the way, you've heard me say it so often, they are the backbone of our country. They do the most hiring. And what we want to hear from them is, how are they looking at inflation right now? Are they able to get loans? Do they want loans? Because the last report, it was pretty mixed, and many saying, look, we're not going out to borrow, but we want to hear what they have to say now. What are their hiring expectations? And above all else, are they spending on capital equipment? And what are they seeing in terms of sales? So remember, sales are what motivates them, right? And that is extremely important. So that's coming out tomorrow. And then, of course, then we have on Wednesday is the Consumer Price Index. Crucial. Obviously, this looks back, but we are paying attention to the headline expectations are that continues to edge lower. And as we all know, the Fed is focused on that recalcitrant core, and they call it super core, but core consumer price index, X real estate. So we want to see whether or not that stickiness is beginning to unwind. Right now, the consumer price index is crucial. It will be followed the next day by the producer price index, PPI. And what we have seen is those prices in the kind of pipeline for production, they're coming down. They're coming down. And the last report that we had showed they were coming down meaningfully. We want to make sure that that is continuing. And then on Friday, we will have the preliminary University of Michigan Consumer Sentiment Report. What are we looking for there? Well, we have seen consumer sentiment rising in other reports. Is it continuing? And then, because of the Fed still in play, we want to see how do consumers view future inflation. This is very important for the Federal Reserve because they want to make sure that consumers' expectations on inflation are anchored, meaning we're not, suddenly saying, oh my goodness, it's going to move to 3%, 4%. That is the opposite of what they want to see, and they will go and raise rates in order to clamp that down. And they're talking, their public comments will be much more hawkish in order to push those expectations down. Good news is that across the country, gasoline prices have steadied and they've been coming down a bit. That has a major effect on consumer expectations for inflation, by the way. So all in all, that's what we have going on this week. In terms of geopolitical, the Secretary of the Treasury, Janet Yellen, came back from Beijing. There's criticism from both sides. Obviously, she didn't do this, they didn't talk about that. But the goal of the meeting was to just keep talking and, quote unquote, to find common economic ground. But nothing has changed in terms of expectations that the embargo list from the U.S. is going to continue, that it will, be enforced, and it will become enforced in terms of cloud computing services and also artificial intelligence software technology. And the reason for this is the U.S. doesn't want these technologies finding their way into their military buildup. The other aspect of it is that the Chinese have come back, and that hasn't changed, where they are going to place an embargo on rare minerals. They actually own quite a bit of them, and also on metals. That doesn't mean that the U.S. was caught off guard. They expected this, actually, and they're looking for, as is NATO, looking for other suppliers. So, but that hasn't changed. Taiwan still remains an issue for China and U.S. and parts of NATO. In addition to this, I want to mention that China, as a important engine of growth globally, is, according to the most recent data that just came out, still fighting deflationary trends. And the response from the government seems to be, well, we can help in terms of monetary policy. We can tweak, levels that the banks, People's Bank of China, can introduce for property developers and consumers and so on, tax benefits. But what the market is looking for is a broad, strong infrastructure, or just some sort of fiscally stimulated response to this, including a focus on high-tech manufacturing, which is where China wants to go. They want to move away from heavy industrial production to a kind of smarter, more sophisticated manufacturing sector. But so far, all we hear from officials is that they are looking at a targeted approach. Very soon, in a couple of weeks, there's going to be a big Communist Party meeting in which they will discuss what they're going to do, their goals and objectives for the second half of the year. The market is obviously hoping that they come out with a very strong fiscally stimulated program to spur growth in the world's second largest economy. That said, with all of this, what you are also looking at are other emerging markets that are doing well, absent China's participation in the global economy. And so this is a theme that seems to be unwinding, and we will be following that very closely. As I close, the market is up. This is Monday, and this is in the morning. We don't know where this is going to take us, but it's a market that wants more information, and certainly it's going to get that this week. Again, it will be from the CPI report, the PPI report, and most important, actually, is we're hearing from companies, and this is the start of that earnings season and the guidance that these companies can offer. So it's going to be a very important earnings season, and it's an important week, despite the fact that we are in the midst of July, actually, and seasonality takes hold, and seasonality tends to be a little bit slower this month. I think particularly as we had such a very strong first half performance. Have a good week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.